gold under $2,000 is unsustainable, and it offers stackers and those seeking a first-tier zero counterparty risk wealth protection vehicle a massive opportunity to act now while they can. And the pivot point where this Fed-induced derivative gold leverage backfires, triggering full compliance and a gold market price reset that reflects real supply-demand fundamentals, is being brought forward, driven by the strongest reporting competing global physical gold demand since Nixon closed the dollar exchangeability pegged to a fixed price of gold. Even larger accompanying central bank monetary gold demand escapes central bank reporting requirements and flies under the radar, guys.
Andrew Maguire, a true titan in the financial world with an unparalleled wealth of knowledge and experience in the gold market. In this video, Andrew Maguire reveals gold market developments in Q3 and Q4 of 2023, focusing on Basel III NSFR's impact. Gold prices struggled for direction in early Asian trading on Tuesday, July 25th, as traders braced for a widely anticipated rate hike along with monetary policy clues from the U.S. Federal Reserve over the next 2 days. Gold was also an attractive safe haven asset as the world went through the Cold War between the West and Russia. Fast forward to today, and the world has never been more fragmented since Russia invaded Ukraine last year. Andrew emphasizes the compelling investment opportunity of purchasing gold, especially at its price below $2,000. A new investors survey from State Street Global Advisors has been making the news rounds lately, highlighting a surprising trend in the gold market. Kitco News was actually one of the first to cover this survey, which reported that millennials have the highest percentage of gold in their investment portfolio at around 17%. Both Generation X and baby boomers hold about 10% of their portfolio in gold. Following the 2008 financial crisis, and in response to a general consensus that the banking system was undercapitalized, U.S. regulators agreed to and implemented the Basel III reforms, which significantly increased the quantity and improved the quality of capital banks maintain to absorb losses. As a result, capital across the system grew substantially. While Andrew Maguire reveals Basel III rules to eliminate 50% evaluation haircut on physical gold reserves from March 2011 to January 2021. Maguire emphasizes that the third and fourth quarter actions is heavily influenced by a bullish trend in physical gold, closely connected to silver. In the first quarter of 2023, physical gold demand was up 22% year-over-year. This was the highest quarterly demand for physical gold since 2016, while paper gold demand was down 15%. The data for 2023 suggests that the bullish case for physical gold is still intact. We will now bring you clips of Andrew Maguire from his recent interview with Kinesis Money. Before we proceed further in this video, please make sure to subscribe our channel and click the bell icon to stay updated.
Yeah, let's start by updating the third and the fourth quarter setup, which is what most people want to know. Yeah, we've been through the first 6 months. And obviously not just for gold, but for joined at the hip silver. And what we're trying to do here is really to provide information that's not generally available, really. And the purpose really is so you can make, really, to assist yourselves and others in making comprehensive assessments, more comprehensive assessments. There's so much of a single narrative out there on so many things. Now, the culmination of the third and fourth quarter 2023 action is very much driven by a bullish physical gold versus this depleting paper gold framework, which since, as you say, Basel III NSFR standards were implemented at the open of 2023 trading, what it's done is forced global liquidity providers, and we're talking about the first tier market makers here, to one-to-one back foreign exchange over-the-counter gold with physical bullion. If you remember, foreign exchange, gold is a foreign exchange cross, much like the dollar is to the euro, etc., etc. So obviously, they didn't used to have to back it. Now they do. So in other words, and the reason this was a game changer for the first time following over 50 years since Nixon had ended the ability to exchange dollars for gold bullion, when Basel III reclassified this foreign exchange gold as a first-tier asset class on the 1st of January, what it did was force the banks making markets in the multi-trillion dollar, I mean, this is talking about a multi-trillion dollar marketplace, foreign exchange, gold marketplace, that is, to be actually one-to-one physically backed with bullion, which they never were. However, as we've drawn attention to, as a direct result of the Fed-driven war against gold following the weaponizing of the US dollar against Russia, and in turn, Russia weaponizing gold back in March 2022 against the dollar, the Fed-infested paper-settled COMEX markets have still not complied with Basel III NSFR conditions, but what we're drawing attention to is that this disconnect between physically deliverable global foreign exchange gold has opened up a huge opportunity for all of us to capitalize on this fast closing window. Now, it's not fully realized by the majority of blinkered US traders because they're siloed inside the COMEX marketplace, banned from trading the deliverable 10 times larger foreign exchange gold markets, which are, as I say, are deliverable, that central banks and sovereign buyers are quietly capitalizing on this opportunity to exchange their rapidly depreciating dollars for bullion. And it's not easily apparent because physical buying is unleveraged and flies under the smoke and mirrors world of the massively leveraged derivative markets centered in the US. And we call this the COMEX tail wagging the physical market dog. We've talked about that multiple times. But the hidden opportunity lays in that this ever-widening paper market disconnect is reaching an inflection point that is evidencing the physical bullion markets irreversibly absorbing the remnants of this over 50 years of paper market generated liquidity. Now, while this divergent process has been muted by the Fed and its agent banks continuing to sell large swathes of leveraged derivative gold to prop up the competing US dollar treasuries and the weaponized dollar against foreign exchange gold.
During the interview, Andrew Maguire discussed the current situation regarding the proposed gold-backed BRICS currency. A BRICS currency will not be on the agenda of the bloc summit in South Africa next month, but Brazil, Russia, India, China, and South Africa will continue to switch away from the US dollar, South Africa's senior BRICS diplomat said on Thursday, July 20th. Despite U.S. pressure on South Africa to block Putin's attendance, the discussions about the gold-backed commodity currency are still at the forefront of the summit. The upcoming August summit, potentially attended by more than 40 nations, is set to highlight a pivotal BRICS initiative to challenge the U.S. dollar's global hegemony. Andrew believes that once this gold-backed currency structure is formalized, it will put significant pressure on the U.S.-centric derivative gold market, leading to its eventual folding. Meanwhile, Andrew also points out the significant developments in the economic partnership between the UAE and India. In October 2022, the UAE and India signed an agreement to invest $100 billion in renewable energy projects over the next 5 years. This agreement is expected to boost demand for silver. The UAE and India are two of the world's largest consumers of silver. In 2021, the UAE consumed an estimated 1,200 tons of silver, while India consumed an estimated 1,000 tons. Let's get back to interview.
As was reported by the US official mouthpiece Reuters last Thursday, the US are attempting to halt the BRICS currency being discussed at the BRICS August summit. However, while severe US pressure has clearly been put on the South African government to block Putin from attending, which they have, followed by South Africa's BRICS ambassador playing down that gold-backed currency would be tabled, our Russian contacts continue to reaffirm that the very well-developed structure of the proposed gold-backed commodity currency is most definitely front and center of the upcoming summit. And of course it will be. What Reuters fails to focus on is the plus 40 nations that have expressed an interest in joining the BRICS Plus trading bloc, and that the unipolar weaponized US dollar is one way or the other going to be circumvented by this massive multipolar trading bloc. That is the glue that will bind this trading bloc together. In order to replace the dollar, and with no single currency, that could be the yuan, the ruble, liquid enough to replace trillions of dollars of the energy and commodity trade between these nations, there is only one solution: a gold-backed commodity currency. And if it's not 100% backed with gold, it will be partly backed by gold. Really interestingly, we see Kennedy a couple of days ago come out and talk about backing the US dollar with metals, even if it's a small amount. Well, unfortunately, that killed his uncle, Robert Kennedy, all those years ago. It was doing exactly that. But it's interesting because people are waking up to the fact, hold on, something has to be done. And this is why every single member and the new applicant seeking to join this trading bloc has been buying physical gold openly, and as far as monetary gold is concerned, it's just off-grid. Once this currency structure is formalized, the US-centric derivative gold market will be forced to fold. It is that simple. It has to. Also, there's no coincidence that the UAE and India, you're like this, Shane, their economic partnership agreement just came into force, but details are just spilling out. The partnership moves to reduce silver import and taxes to zero by 2032. So immediately we have a 15% premium that will reduce to 9%, then gradually to zero. This will trigger very, very large Indian silver demand. Monetary gold duty rate will also reduce to 1%, which is going to severely cut smuggling, the need to smuggle. Now, with all of these partnerships being cemented, we once more need to underscore that the Bank of International Settlements, along with every other Western central bank and every single first and second tier bank, except the wrong-footed Fed, are long physical gold, anticipating much higher prices into a multipolar pricing environment. Also, ultimately providing these forward-looking central banks the option of revaluing gold held in their underpriced gold revaluation accounts. We've been into some granular detail on how that works in prior episodes. It's a simple process, and it can be effected simply by selling their underpriced gold reserves and rebuying them at market simultaneously. And with US treasuries and currently valued at $42 an ounce, revaluing gold at, say, $2,000 would reinvigorate a rapidly depreciating unbacked dollar.
As the world faces geopolitical tensions and economic uncertainties, the demand for safe haven assets like gold and silver could see further growth. The proposed brick, according to Kiyosaki, could be linked with gold, where 1 brick equals 1 ounce of gold. This arrangement might catapult gold prices to a record $3,000 per ounce, a significant leap from the current price around $1,972. Do you think upcoming developments will shape the future of gold and global economy? Share your thoughts in comments section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.